Very good morning, friends. So I hope you're all doing well. And today we're going to start a next phase of consolidation. We've been doing Index 103, which talks about business combination. And I think now comes the main core standard on consolidation, that is Index 110. And of course, the name of the standard is also Consolidated Financial Statements. Now, I think as you know, many people start with the Index 110, a few pertinent questions which comes to the mind is the procedure of consolidation similar to what we have done at the intermediate level? What we did in AS21, is the procedures the same? Well, I would say yes. Many of the procedures are, of course, quite similar in nature. But I would still, request and insist that learn this from a new perception, because I'm going to give you a consolidation technique, which again is going to be a 7-step model. And what we have done in Index 103 was also a 7-step model on acquisition accounting. And here also I'm going to give you a 7-step model, but that would be coming later. So invariably, you do get a question on making a consolidated financial statements as well. But apart from making a consolidated financial statements, we need to also understand a few more aspects. So I think on a broader level, if somebody were to tell me that, okay, can you segregate Index 110 in terms of the broader elements of discussion? I would say yes, we can divide this in almost 3 parts. I would say the first part is understanding the scope of the standard and the assessment of control. Now, when I say the scope of the standard, which means that we need to first of all consider every time a company gets a control over another company, is consolidation mandatory or not? So I think we're going to work upon that issue also through the scope of the standard. There are a couple of questions which are given in the study material which elaborates the concept of scope of the standard. So today, my initial agenda is going to be explaining the scope of the standard. So we can say in the block number 1, you can say we will look at the scope of the standard along with the concept of control assessment. Control assessment, I think I've said that invariably a number of times during our discussions in Index 103 as well, that control assessment is not something which is rule based. In Index, the control assessment is supposed to be, you can say, a principle based assessment. Now, when I say it's a principle based assessment, that means we have got a lot of judgmental issues to be applied. So we're going to see, later in our block 1, how do you assess a control? So there will be 2 portions in terms of the block number 1, understanding the scope of the standard and understanding the control assessment. Then I would say the block number 2 could be divided in terms of the practical consolidation technique. How do you make a consolidated balance sheet? That's one component. How do you make a consolidated income statement? That is another component. So our block number 2 will be the core accounting portion, how the consolidation for the income statement and the balance sheet is done. Then I would say there is a block number 3 where we're going to discuss, you can say, the other aspects. The other aspects would be typically in terms of considering changes in the ownership interest of an entity. As an investor, let's say, for example, I had a control over a company, but I made a disposal of shares. Or let's say I had a control and I further acquire more shares in the company. So it could be a further acquisition, it could be a disposal. And that's what we technically say, there are changes in the ownership interest in the entity. So our entire focus of discussions in terms of Index 110 is going to be divided in terms of these 3 blocks. So I think I'll just pen that down as well, because as you consolidate the standard at the back of your mind, you know that, okay, we are discussing these 3 blocks. So to begin with, let's pen down the initial thought process. So when we're going to cover the concept of Index 110, that deals with CFS, that's Consolidated Financial Statements. So I would divide the entire discussions in the standard in a total of 3 blocks. So there is a block number 1, then there is going to be a block number 2, And then there is going to be a block number 3. So in our discussions in terms of the block number 1, we're going to focus on the scope and the control assessment. So in the first block, we'll talk in terms of the scope of the standard, and we'll talk of the control assessment. How do you make an assessment that there is a control which is present? Because control is the main factor which leads to consolidation. If there is a control, then only we can say the consolidation would occur, otherwise not, at least under 110. And in terms of the block number 2, we're going to look at the consolidation procedures. We're going to look at the consolidation procedures. And when I'm looking at the consolidation procedures, we're going to focus on the consolidated balance sheet. We're going to focus on the consolidated profit and loss. How do we make a consolidated balance sheet and a consolidated P&L? And finally, in terms of block 3, I'll put it as other aspects. And the most crucial other aspect I'm going to discuss is the changes in ownership interest. The changes in ownership interest. So if there are any changes in the percentage held by the investor, that's what we're going to cover in terms of the block number 3. I hope now the basic thought process stands clear how we're going to proceed with the standard. This helps you to not only enter the standard, but it also helps you, once you revise the entire standard, you know how the dots will get connected. Okay, so let's, I think, begin the journey. So we're going to start our discussions with reference to the scope of the standard. Now, I'm carrying a few inputs which are given in the standard. So I'm just going to share that with you. So I am coming to the scope of the standard, which is the para number 4. So let me just zoom this across. I hope, friends, this is clearly visible. I think so. So will these lectures cover only Index 110 or 111, 28, 27, 112 also? Yes. All these topics which you mentioned are going to be covered in this. After 110, we're going to go to 111 as well as 28. 27 would be towards the end, so we'll be covering all this chain. 112, as you mentioned, that is more of a disclosure standard, so my focus will not be much on that. But yes, 110, then 111, then 28, and then 27. Yes, everything is a part of the consolidation standards. Correct. Okay, you're most welcome. So let's, I think, read the inputs. Don't worry, I'll make the notes later. Right now, you just need to consider what I'm saying. Just hear me carefully. To begin with, it's going to be a very simple affair. Yes, as we move on to the scope, it might get a little complicated, but trust me, you are going to become, going to get a lot of hold in terms of analyzing the scope of the standard. Let's read. So this is the para number 4 of Index 110, which says an entity that is a parent shall present. It says an entity that is a parent shall present. The word shall is indicative that this is mandatory in nature. That this is mandatory in nature. Now, when he says an entity that is a parent, so when an investor gets a control over the investee, the investor is called the parent. Now, how do you assess a control for the time being? I'm going to consider that if you got more than 50%, I did not say 50, I said more than 50. So for the time being, I'm going to consider if you get more than 50% voting power in a company. So as an investor, you control the investee. As an investor, you're going to be called as a parent. And therefore, the standard says that an entity that is a parent shall present consolidated financial statements. This index applies to all the entities, it says, except as follows. Now we are looking at the para number 4A. The focus is on the para number 4A, small a. Now it says at the very beginning, it says a parent need not present. A parent need not present consolidated financial statements if it meets all the following conditions. I think let me ask you a very basic question. When it says in para number 4A that a parent need not present, is it something which is mandatory or is it something which is optional? When he said the earlier words, it says a parent shall present. That's making a mandate. And then it says a parent need not present. So is it something, you're giving an option to the entity, or is it something you're mandating them? And that's rightly said. So when I say that it need not present, this is completely, you can say, optional on the part of the investor. Now, as we understand the para number 4A, let me tell you one thing very clear so that the thoughts are very clear in your mind. The para number 4A applies only in terms of chain holding. Let me tell you what a chain holding would mean. So for example, there is a company A which has got a control over B and B has got a control over C. So let's say A controls B and let's say B controls C. Now in terms of the para number 4A, the focus is on B, which is the middle company. Let me make one thing very clear, that when you look at the application of para 4A, the presence of a chain is a necessary prerequisite. Don't worry, we'll write down the notes later. But when you're looking at the concept of para number 4A, what is important is that there has to be a chain. If there is no chain, the para number 4A cannot apply. In other words, say for example, if you say that A has got a control over B, that's it. There is no chain in this particular case. If there is no chain in this particular case, trust me, the para number 4A cannot apply in this case. The concept of para 4A choices option can be applied only when you get a chain. Now the chain may not be smaller. It could be, A, B, C, D. It could be A, B, C, D, E. But for understanding, let's keep the chain A, B, C. So the focus in terms of para 4A is on this middle company. So when you're looking at giving a choice of consolidation, B is going to be given a choice. Now first, before we read the para number 4A, when A gets a control over B, then A is required to consolidate B. When B gets a control over C, A is required to consolidate B as well as C. And B is also required to consolidate C. Let me put it again. If A gets a control over B, A is supposed to consolidate B. When B gets a control over C, A will be required to consolidate both B and C. And B will also be required to consolidate C. Now that could duplicate the efforts. Because if A is already consolidating B and C, then why ask B to consolidate C? So the standard sellers thought that, we could give certain kind of exemptions, which is optional in the hands of the company B, that we tell him that, okay, if you fulfill these particular parameters, you got a choice. You may not present a consolidated financial statements, because otherwise it lead to duplication of consolidation, because A is in any case going to consolidate C. So why tell company B that you also consolidate C? So they decided in a chain, provided certain conditions are met, and there are 4 conditions. They said, we'll give a choice to B that if you want to consolidate, you can. If you don't want to consolidate, you may not. Now, let's come to those conditions. It says it is a wholly owned subsidiary. When I say it is a wholly owned subsidiary, I'm looking at B is the wholly owned subsidiary of A. So the first condition is that all the shares of B in my examples are held by A Limited. So B is a wholly owned subsidiary, and if not, the other part is it's a partly owned subsidiary of another entity. And then there is a word and. There is a word and. So when you say that it is a wholly owned subsidiary, the condition 1 is met. Let's make it very clear. If you say that B is a wholly owned subsidiary of A, the condition 1 is met. But if you say that B is a partly owned subsidiary of A, the condition A is not met. There's another sub-condition to be met. And what is that? It says all other owners, including those not entitled to vote, have been informed about and they do not object to the parent not presenting a consolidated financial statements. Now let's consider like this. Let's say, for example, A has got 80% stake in B. So B is a partly owned subsidiary of A. In that particular case, when it is a partly owned subsidiary, it says all the other owner means those people who've got a 20% stake in B. You can call it as NCI, non-controlling interest. Because if A has got 80% stake in B, he's got a control. The remaining 20% is with somebody else, which is non-controlling interest. So it says all other owners, that is NCI, have been informed and they do not object to the parent not presenting a console. So I put it in simple words like this, that you need a NOC, a no objection. So it's not literally that you need a no objection certificate, but I'm just going to pen down the thoughts for a better understanding that you need a NOC from the minority, or you can say the non-controlling interest. So let's put the condition number A like this. So we can say if B is a wholly owned subsidiary of A, condition 1 met. If B is a partly owned subsidiary of A, then get an NOC from that remaining people, that is NCI. So the condition number 1 goes like this. There are two situations. If B is a wholly owned subsidiary, condition 1 is met. Finish. If B is a partly owned subsidiary, then I'm going to put across a question. And I'll say, did you obtain a no objection certificate? Did you inform them, that is the NCI, and they've got no objections if you don't present a consolidated financials? Then I'm fine. Then the condition number 1 is met. Clear with it, friends? Am I clear with the first condition? What happens if it is wholly owned, and what happens if it is partly owned? Great. Now let's go to the next one. It says it's debt or equity instruments. It means we're looking at B. The debt or equity instruments are not traded in a public market. I'm not reading the brackets. In other words, we are saying that the debt equity securities of B Limited are not listed on any stock exchange. In other words, B is not a listed company. Because if B becomes a listed company, then I think the stakeholders have got a very keen interest in the company. So in this particular case, the standard setters are a very clear-cut thought that, we will give them a choice of not consolidating only if you're not a publicly traded company. So if B is an unlisted company, neither its debt nor its equity securities are traded in the market, are listed on the stock exchange, then I'm fine. Then comes the clause number 3. It says it did not file, B did not file, nor is in the process of filing its financial statements with the Security Commission, SEBI in this case, or other regulatory organization for the purpose of issuing any class of instruments in a public market. Which means neither it is listed in the condition number 2, nor it is in the process of getting listed as well. So they made it very clear that neither B Limited is listed today, nor it is in the process of getting listed as well. So it did not file, nor it is in the process of filing its financial statements with SEBI. Because if you're planning to come out with a public issue, in those particular cases, filing the financial statements with SEBI would become a mandate. So therefore, they decided that let's go very safe. B is not listed, that's 1. B is not in the process of getting listed as well, number 3. Simple and straight. And then comes the condition number 4. It says its ultimate parent or any intermediate parent. It says ultimate parent or an intermediate parent. Now, for example, if the chain gets longer, A has got shares in B, B has got shares in C. Now, let's say I'm applying this para number 4A for the company C. In this particular case, I would say A is the ultimate parent of C. And I would say B is the intermediate parent of C. Because if the chain gets longer, then you can say he becomes the ultimate. He becomes the ultimate parent. And B would become an intermediate parent. So it says in the fourth condition, the ultimate or any intermediate parent produces financial statements that are available for public use and they comply with Ind AS in which subsidies are consolidated or measured at FPTPL in accordance with Ind AS. So basically, if you look at the fourth condition, in the fourth condition, I need to first of all appreciate and understand that any of the intermediate parent or ultimate parent is producing financial statements for public use. That is one. And the second is it is in accordance with Ind AS. So I would say there are two subconditions of the fourth clause, that the financial statements prepared by the ultimate parent or the intermediate parent is available for public use. And the second condition is that they comply with Ind AS. So he's already presenting the ultimate parent, or you can say any of the intermediate parent, is presenting consolidated financial statements for public use, number one, and those financial statements need to be in accordance with Ind AS, then I would say yes, the condition is met. Because if my parent, any of the parent, intermediate or ultimate, is presenting a consolidated financial statements, then I think I can tell B that, let's not duplicate the efforts. So you can see the essence in all these four conditions is pretty simple and straight. That the first thing is that B is not a listed company, nor it is in the process of getting listed. So the public stake is not much at stake. So there is not much public stake in that because they're not listed company, not in the process of listing. And if your ultimate parents, intermediate parents are presenting console, then in that particular case, let's avoid the duplication. And also that if nobody's got any objections to the fact that you present a consolidated financial statements, why tell them to make a console? That's a free choice. Even if you're getting all the conditions of para number 4A met and you still decide that I want to present a consolidated financial statements, nobody stops you. But the ultimate fact is that if these four conditions are met, you're getting a choice. You don't want to consolidate, it's fine. You still want to consolidate, it's fine. Right, friends, I hope I got my dots connected well. You're clear with all the four conditions. I think I can just pen them down as well. All the four conditions. Para 4A gives you an option that you may or may not consolidate provided all the four conditions, as we said, is met. Okay, so far so good. So let me do one thing. Let me just add on some notes at this stage. So we are documenting the scope of the standard. It's a block number 1 where we decided the scope of the standard. So let's pen this down. So I'm actually giving the heading block number 1 and let's call this as scope of Index 110. So we're looking at the scope of Index 110. So this is, I'm also giving a para number reference just for maybe later reference. So I'm just putting that para number 4A as well. And the key agenda in terms of para number 4A is that this is completely optional in nature. It is completely optional in nature. So just to make a mention, even if all four conditions are met, consolidated financial statements may be presented. So underline may be presented. So it's a complete choice on the part of the parent company. So this is one observation which you need to keep in mind. And then there is a second observation, which is para number 4A, that is small a, applies. Para number 4A, small a applies only. It applies only when there is a chain holding. When there is a chain holding, let's underline chain holding. So I think these are the two important inputs which you need to keep in mind as far as the para number 4A is concerned. It gives you a complete choice, that is one, and it's applicable only when there is a chain holding. If there is no chain, the para number 4A cannot trigger in this case. Right, so let's also now pen down the 4 conditions also at this stage. So as far as the 4 conditions are concerned, we'll put this in a small little diagram. So we've got the condition number 1, we've got the condition number 2, we've got the condition number 3, and the condition number 4. So there are a total of 4 conditions attached to the aspect of para number 4A. Now the first condition, we can say there are 2 situations. So I would say in terms of the condition number 1, there are 2 situations, situation 1 and situation number 2. So I think just for the ease of understanding, let's consider an example. So let's consider that A has got a control over B and B has got a control over C. So we're looking at these 4 conditions from the point of view of B. So as I document these conditions, I'll consider the middle company B as a base to understand. So there are 2 situations. Either the 2 situations would occur. So we can say B is a wholly owned subsidiary of A. B is a wholly owned subsidiary of A. So if you say that it is a wholly owned subsidiary, the condition is met, no further evaluations. Or we can say B is a partly owned subsidiary. B is a partly owned subsidiary of A. So this is wholly owned and this is partly owned. Now, if it is partly owned, we can say we need, I'm putting it as NOC, please don't write it in the exams as NOC. We just need a no objection. It's not a certificate, don't misinterpret that you need a certificate in NOC. It's just for understanding. So we need a NOC from NCI. We need a NOC from the non-controlling interest in this case. The people who are other than the controlling interest, we need a NOC. Next, we are given the condition number 2. The condition number 2 is that B is not a listed company. B is not a listed company. And we can say that is neither debt or equity, neither debt or equity is traded. So it should not be traded on the stock exchange. And the third condition is B is not in the process. B is not in the process of getting listed. B is not in the process of getting listed as well. So neither it is listed nor it is in the process of getting listed as well. And finally, the condition number 4 is ultimate parent. So we can say ultimate parent or intermediate parent. So ultimate parent, or we can say the intermediate parent. So the chain gets longer, you'll have ultimate and intermediate parent. So ultimate or intermediate parent, I would say there are 2 factors. So one of the factor is that they are, you can say, presenting financial statements. They are presenting consolidated financial statements for public use. So they are presenting consolidated financial statements for public use. That is one. And plus, the second condition is that it is as per Ind AS. So there are 2 focus points. One is that it is for public use, and the other it is presented as per Ind AS. Right, friends, so I think the para number 4 is done, and I think that should be quite clear to you at this stage, though there might be 1 or 2 inputs which we will discuss later. But I think we get the dots connected well, that you just need to say, is it a chain holding? Yes. Then para 4 is A is a matter of choice. That's second input. And once you decide that yes, there is a chain, and you decide that in this particular case it's a choice, you put across the question number 1. Is the middle company wholly owned subsidiary? Condition 1 met. If it is partly owned subsidiary, the NCI should have no objection. Then B is not listed. Then B is not in the process of getting listed. And then A, which is in my example, the ultimate or the intermediate parent, is presenting a consolidated financial statements for public use. That's 1. And it is in accordance with Ind AS. There is 2. If all these conditions are met, I tell B Limited, you've got a choice. You want to consolidate, you can. You don't want to consolidate, you do not. Right, friends, I believe we're 100% clear on the agenda. 100% clear, I think not even 99% at this stage. That's wonderful indeed. So now let's go forward. Then I'm going to show you another inputs, which is on para number 4B. I'll just crop this up to have a little inputs at this stage. So there is another para number 4B, which is given in the standard, which is again on the scope. So these para 5, 6, 7, we'll see later. That is on the control assessment. Let's first of all look at the para number 4B now. It says in terms of para 4B, a parent that is an investment entity. A parent that is an investment entity. Now the question rises, what is an investment entity? So without getting into technical details at this stage, let's consider a parent which is called an IE, investment entity, is he is investing into the shares of other investee company on behalf of other investors. So other investors approach me and I invest into other companies where the objective is to get a capital appreciation. The objective is to earn a return income. Remember the concept of investment property. Where you invest in a property, where you invest in land and or building with the sole objective of getting a capital appreciation or getting a rental income. Same is the case in terms of investment property. Though there are a lot of other parameters also, but for the time being, let's consider a group of investors unrelated to me approach me and tell me that we want you to act as a, act on our behalf, and you make further investments in other company. And with the sole objective of giving us a capital appreciation of our money, with the sole objective of getting a return. So let's say, for example, as an investment entity, when I get the money on behalf of my investors, who are unrelated group of investors, and I am making investments in other companies, I may get a control which is unintentional. I may get a control, where I don't intend to get a control, because I'm just taking the money of my investors, putting it in other companies, and the idea is not to get a control. So in those particular cases, the entire objective is that I want a capital appreciation for my clients. I want a return income for my clients. So even if I'm getting a control by default in those companies where I invested on behalf of my clients, I cannot be called to consolidate those subsidiaries, because the intention was only to act as on behalf of my clients, my group of investors, and I acquire a stake in the other company where I get a control. So the standard feels in these particular cases, since the objective is not to get a control, so your objective is purely a capital appreciations or return in the form of dividends or interest on those security. Let's tell you to capture those investments at a fair value, and let's capture them at a fair value through P&L. Because if you're making those investments with a pure objective of getting a capital gains, or with a pure objective of getting some returns in the form of dividends and interest, let's tell you to record those investments at a fair value through P&L without asking you to consolidate. That was in very simple brief what an investment entity is. The company which is acting on behalf of the group of investors with the sole objective of getting a capital appreciations and getting a return in the form of interest and dividends is getting a control which is by default, where they've got no intentions to receive the control. So considering this perception, the standard setters gave an exemption in terms of these investment entity. So it says a parent that is an investment shall not present. Shall not present. So am I giving a choice to these investment entity? Just like that para number 4, clause A. Or am I mandating them and telling them that, boss, you cannot consolidate if you are an investment entity? What do you say? So it says it shall not present. That means I am making this mandatory in nature. I'm telling them that you cannot consolidate. So unlike, that's rightly said, unlike the situation where you can say under para 4A, you're giving a choice to the parent company. Here, I'm not giving them a choice. I'm saying, no, you cannot consolidate in this case. So it says it shall not present consolidated financial statements if it is required in accordance with para number 31 of this Ind AS to measure all the subsidiaries at a fair value through P&L. So they will measure the investments at FVTPL. They're going to measure the investments at FVTPL. But para number 4B is to be read along with the concept of para number 31 as well. Because it says out here that in accordance with para number 31 of this Ind AS. So I think before we reach any conclusions on para 4B, we need to consider what does the para number 31 also state. But for the time being, let me also clarify another thing. This para number 4B can apply even if there is no chain. The para number 4B can apply even if there is no chain. Now, if somebody were to ask me that, can you give me a basic distinction between the para 4A and the para 4B? I'll tell them that there are two basic points of distinction. So please hear this carefully. So if somebody says that, okay, give me your thoughts in terms of para 4A and in terms of para 4B, I'll say there are two major differences. Number one, the para number 4A is going to trigger only if there is a chain. The para number 4B can trigger even if there is no chain. So does para number 4B trigger if there is a chain? Yes, it can. Yes, it can. So, but one thing is very clear, 4A can trigger only if there is a chain. If it is a simple case of A and B, para 4A cannot trigger. But para number 4B can trigger even if there is no chain. There is one area of difference. The second is that once you meet the four conditions of para number 4A, consolidation is a matter of choice. It is completely optional. But the para number 4B is making a complete prohibition. They say that if you're an investment entity, consolidation cannot take place. So keep these two things very clear in mind. 4A is a chain. 4B can be applied even without a chain. 4A is optional, but 4B is something which is mandatory in nature. Don't worry, we'll pen this down later. But I think I need to first take you to the para number 31 because there is something which is stated in terms of para number 31. So let's have a look at the para number 31 as well as the para number 32 as well. So this is an explanation which is given in terms of the para number 4B. So I'm looking at 31. I'm looking at para number 32. So we'll read both of them and we'll get some interesting results in this case. So let's first read the inputs which are given in terms of para number 31 and in terms of para number 32. Now watch this, hear this carefully. It says, except as described in para number 32, an investment entity shall not consolidate its subsidiary or apply Ind AS 103 when it obtains a control of another entity. It seems that he is giving you an exception in para number 32. The para number 31 is reiterating what para number 4B said. The para number 4B said that if you're an investment entity, then you are not required to consolidate your subsidiary. The para number 31 exactly says that, but the only thing is that it gives you an exception in terms of para number 32. It says, except what I'll tell you in 32, investment entity shall not consolidate its subsidiary. Instead, an investment entity shall measure the investment in a subsidiary at FPTPL in accordance with Ind AS 109. In accordance with Ind AS 109. Now, let me tell you one thing point blank, which is necessary in order to understand and get a grip over the concept. If you acquire investment in an unrelated party, it is supposed to be Ind AS 109, which tells you to capture the investment at a fair value through P&L or fair value through OCI with no recycling. Mind the words carefully. If you've got an investment in an unrelated party, it is supposed to be Ind AS 109, where you take the investments at a fair value through P&L or a fair value through other comprehensive income without any recycling. Second, when you make an investment in a related party and you are an investment entity, so it's a relation is there. So when you get a control, but you are an investment entity, you cannot consolidate. You cannot consolidate, but still I'm not applying Ind AS 109. Ind AS 110 itself tells me that you need to consolidate, you do need to consolidate, but measure the investments at FPTPL only. So unrelated equity investments is FPTPL, FPTOCI. Then related party, but you are an investment entity as a parent, no consolidation, and the investment is FPTPL. Then comes the third case that when you say that you are related company, but you're not an investment entity. As a parent, you're not an investment entity. You are required to consolidate as per 110. So I can broadly divide this in two parts. If you're unrelated, 109. If you're related, let me see, if you're a parent who is investment entity, no consolidation, then FPTPL. But if you're a related party, but you're not investment entity, you are required to consolidate. Don't worry, we'll pen down the thoughts later. Let's go ahead. Now there is an exception which is given in terms of para number 32, wherein he talks about maybe consolidating a subsidiary. Now let's read. Notwithstanding the requirements in para number 31, it says, I'm giving you an exception in 31. If an investment entity has a subsidiary that is not itself an investment entity, and it says, and whose main purpose and activities are providing services that relates to the investment entity activities, it shall consolidate that subsidiary in accordance with the standard. Wow. Now he's going a little beyond. So what's this? This is going to be a little tricky. So just watch this. So I'm looking at a company A and I'm looking at a company B. Let's say A is an investment entity, but B is not an investment entity. So the company A is got control over B. A is an investment entity, the parent, but B is not an investment entity. Now let's read. It says if an investment entity, that is A in my example, has a subsidiary, that is B, which is not an investment entity, but, and whose main purpose is providing services that relates to the investment entity's activity. B is not an investment entity, but he's providing services which are similar to A. Now, a small little question will come to your mind, sir. If B is providing services which are similar to A Limited, then why it did not become an investment entity? I'll tell you, To become an investment entity, there are a lot of stringent conditions. I would say there are almost like, 6, 7 conditions, and you need to meet all those 6, 7 conditions. Even if one of the condition fails, you fail to become an investment entity. So it is quite possible that B is doing activities which are similar to A, but still, because of the stringency of parameters, deciding that it's an investment entity, he fails to be captured, he fails to be designated as an investment entity. Now, I'm not getting into what kind of parameters are there, but it is quite possible that because of the stringent parameters of calling it as an investment entity, the standard setters are a very clear-cut thought process that if you want to give an exemption to a company not to consolidate, we need some very stricter parameters. Because if you look at the position in terms of Accounting Standard 21, companies were avoiding consolidations where their subsidiaries were loss-making companies on the ground that it's a temporary investment. It's been, cases in practical world under AS21 where even SEBI had pinpointed that many parent companies were not consolidating their subsidiaries, and the ground they were saying that it's a temporary investment, but the intention was not to consolidate a loss-making subsidiary. So when this index was made, the standard setters were very conscious of the fact that we will not give any exemptions in cases where genuine consolidation needs to be done. So they decided that, if I'm telling an investment entity not to consolidate, let's give them a lot of complicated parameters to apply. If you're not able to fulfill those parameters, then in those particular cases, consolidations will be done. So it is quite possible that B Limited does a work which is quite similar to A. But because of all those complicated parameters which B is supposed to meet, he doesn't pass those parameters. In spite of that, his works are quite similar to A. He fails those parameters, and therefore he does not become an investment entity. So therefore they said, and the main purpose and activities is providing services that relates to the investment entity. If his main purpose and activities are similar to those of A, I will tell A, you need to consolidate. You need to consolidate in this particular case. So a couple of other things are coming to the mind as well. So the other things which is coming is, this is an investment entity, this is an investment entity, no consolidation. If you look at the corollary of this, you're saying A is an investment entity, B is not an investment entity, condition 1. And B is doing something which is similar to A, then you consolidate. So which means if A is an investment, B is an investment, I will not consolidate. So let's say A is an investment entity, B is not an investment entity, but his work is not similar to A. So you fail the condition whose main purpose is not similar to A. Then also I will not consolidate. So now I'm confused. I'm now confused, sir, when to consolidate and when not to consolidate. So let me do one thing. Let me make your life simple. I'll give you a simple 3-step model in terms of deciding when A will consolidate B and when A will not consolidate B. Let's make life simple. Now watch this. So I'm going to create a 3-step model on this. I'll document that later, but let me just give you the thought process of step number 1, step number 2, and step number 3. That will take care of the para number 32, the exception which is there in para 31. So the first thing what I'm going to do, I will first of all say that the A Limited, I will say, let me ask a question that is A an investment entity? If A is not an investment entity, he cannot get the benefit of para 4B. He cannot get the benefit of para 31. So if A is not an investment entity, I'll tell him, boss, you need to consolidate. But if he says, yes, I am an investment entity, I go to step 2. I always tell people on the lighter side, don't judge me on this, but I just remember on a very lighter side, if you've seen that movie Jawan, And there was a very interesting dialogue in that movie, which you can apply in terms of para number 31. बेटे से क्या पूछता है बाप से पूछ. So what are you going to do? First of all, you're going to ask the parent company and then ask the son. So बेटे से क्या पूछता है बाप से पूछ. So in this particular case, you will first of all ask a question to A Limited. Is it an investment entity? If A is an investment entity, then you go to step number 2. If A is not an investment entity, para 4B cannot apply. Then let's go to the next one. Now I will put a question that is B an investment entity? If you say yes, B is an investment entity, no consolidation. No consolidation. So if A is the investment, B is the investment, no consolidation. But if you say B is not, if you say B is not an investment entity, then you go to step 3. So A is not an investment entity, please consolidate. A is an investment entity, go to step number 2. Ask now, is B an investment entity? Yes, don't consolidate. If B is not an investment entity, you go to step 3, and now you see that the purpose and activities. Now you decide the purpose and the activities of B Limited. Is it similar or is it not? You now need to see that is the purpose and activities of B similar or not. Now you say yes, the activities are similar. Please consolidate. Activities are not similar, you can't consolidate. And the reason is logic is simple. If the activities are similar, you got to consolidate apples. But if the activities are not similar, you can't consolidate apples and orange. So in this particular case, to consolidate, what is important is that the purpose and activities of B is similar to the purpose and activities of A. If it is similar, then you say, please consolidate apple. If they are not similar, then you say don't consolidate. Apples, oranges cannot be consolidated. Am I making some good sense, friends, now on this? Don't worry, we will pen this down later. Let's read further. Let's read some inputs further. Then he says a parent of an investment entity. It says a parent of an investment entity shall consolidate all the entity that it controls, including those controlled through an investment subsidiary, unless the parent is an investment entity. Now, in terms of this para 33, he's telling me chain holding. So in terms of para number 33, this is giving reference to a chain. Para number 31, 32 was talking of that there is no chain, and para number 33 is suddenly went to the chain holding as well. Because now he says a parent of an investment entity. So let's consider A, let's consider B, let's consider C. B is an investment entity, but A is not. A parent of an investment entity, A in my example, shall consolidate all the entity that it controls. So A will consolidate B and C as well. A will consolidate B and C as well. It says which are controlled through an investment entity unless the parent is an investment entity. If the parent also becomes an investment entity, then he will get the benefits of para number 31, 32. Oh, some moral of the story. Let me connect the dots. Now, there might be a bit confusions coming in, setting in right at this stage. Let me now consolidate the inputs. Para number 4A applies only in terms of chain. Doesn't apply in a normal case. Para number 4B is applying both in terms of chain and no chain. So if there is no change, apply my 3-step model. So if there is a chain, then also I would say apply my 3-step model. But in this particular case, when you say A is an investment entity, I put the next question. Is the subsidiary also investment entity? Yes, don't consolidate. But if A is investment and B is not investment, I'll say, okay, what does B do? Similar to A, consolidate. Not similar to A, don't consolidate. So I think now let's keep one thing very simple, that in terms of para number 4, clause A, only chain holding, middle company meets the 4 conditions, I'm sorted. I'll give him a choice of consolidating or not. In terms of para number 4B, if there is a chain, if there is no chain, doesn't make a difference. If there is no chain, that means we're just looking at A and B. 3-step model is what you need to apply. Even if there is a chain for the top company, you can again apply the 3-step model. So whether you're looking things from the point of view of A or you're looking things from the point of view of B, if A is an investment entity, apply 3-step model. If A is not an investment entity, then you need to apply para number 4A. And if B is an investment entity, apply the 3-step model. And if B is not an investment entity, then he has to consolidate. Then he's only getting the benefits of 4B, 4A. So can you just tell us, quickly in terms of 4 inputs or, 2-3 cases, which para is going to apply? And can you also document the 3-step model in terms of para number 4, big B? Yes, I'll do that. Let's first of all do one thing. Let's document the 3-step model in 4B. Then I'll give you some permutations, combinations to decide. Then we're ready to do case studies. Okay, so far so good. Let's, I think, take it further. Okay, I'm now going to take it further. Let me first document this inputs to you. So I am going to first of all document the inputs in terms of 3-step model. This is 3-step model, and let me also pinpoint that this is a 3-step model which I am considering in terms of para number 4B, read with para number 31 to para number 33. Makes more technical sense. So we're looking at the para number 4B, which is read with para number 31 to 33. Right now, I'm not looking at a change. So in this case, we can say there are 2 things. Where if you look at para number 31 and 32, there is no chain. There is no chain holding. But if you're looking at para number 33, it talks about the chain holding. It talks about the chain holding in this case. So para number 4B is applicable to chains and no chains put together. After this 3-step model, I'll give you the clarity in terms of how you're going to think. So let's first make a 3-step model in this case. Step number 1. So I'm taking the example A in B. I'm just taking this example for the time being, no chain. I'm taking this example for the time being, considering no chain. Let's not talk about para 33 right now. In the 3-step model, simple case A and B. So I think another important inputs what you need to keep in mind is that para 4B apparently applies when there is no chain. And the second is para number 4B is mandatory in nature. That's the distinction in terms of 4A. That 4B we are looking at if there is no chain and it is mandatory. If you meet the 3-step model, the permutation combination, you cannot consolidate. So let's consider the step number 1. So in my example, is A an investment entity? So we'll put the first question, is A an investment entity? Let's underline investment entity and let's put down something on the investment entity. So we can say investment entity is that the objective of investment is capital appreciation. The objective of the investment is capital appreciation plus, we can say return, brackets, we can say interest and dividends. So the objective is investment is capital appreciations and getting a return, interest and dividend. So when we put across the question that is A an investment entity, we get the answer yes, or we get the answer no. So if you get the answer no, then we can say para 4B not applicable. Para number 4B is not applicable. So we can say A has to consolidate. A has to consolidate. So he's got no choice. He has to consolidate. And since there is no chain, he cannot apply for A. Since there is no chain, he cannot apply for A. I will tell A, you have to consolidate. But if he says yes, then I go to the step number 2. Then I go to the step number 2. If you say yes, I'll go to the step number 2. Let's have a look now on the second step. Second step is that is B an investment entity? The second is we need to see that the subsidiary is an investment entity or not. The parameters of investment entity, of course, remains the same. So when you put across the question is that B is an investment entity. So we can say yes or we can say no. So if you say yes, then no consolidation. Then there is no consolidation required. There is no consolidation by A. So if A, B both are investment entity, no consolidations to be done by A in that case. But if you say no, then you go to the step number 3. Then you go to the step number 3. And in terms of the step number 3, now you need to see the purpose. What is the purpose? What is the purpose of purpose and activities? So what is the purpose and activities of B? So what is the purpose and activities of B? So is the purpose activities of B similar to A or not? So we can put it in 2 parts. So we can say it is similar to A, or we can say it is not similar to A. It is not similar to A. So when you say it is similar to A, then we can say A has to consolidate. Then A has to consolidate in this case. And when you say it's not similar to A is not required to consolidate. A is not required to consolidate in this particular case. Right, I guess my thought process clear, but I still need to connect some dots at this stage because this is the entire analysis without any chain. I need to give you some inputs on the concept of chain as well. So let's, I think, take it further. Let me just add a few more inputs at this particular stage. So I'm now just going to connect the dots, looking at the para number 4, clause A, and looking at the para number 4B. Let's, I think, first of all, get one thing very clear. Now, what's this? This is going to be icing on the cake. Because if you're able to get this, then I think we're going absolutely fine. So I'm going to consider now the situations. I'm going to consider now the first clarification. So that everything is crystal clear. So as I move forward, please watch me carefully. I'm just connecting the dots of all these discussions in one single go. The first thing is I'm looking at that there is no chain. The second is I'm looking at that there is a chain. Now, when there is no chain, I am now looking at the concept of para number 4A. I'm looking at the concept of para number 4B. I'm looking at the concept of para number 4A. And I'm looking at the concept of para number 4B. Now, let me put some questions, friends. If you can answer these questions, then I think your fundas are going great. So we're just trying to make a summary chart of the concept. We're trying to make the summary chart of this concept. And I think one thing which I would like to very clearly pinpoint at this stage, that para number 4A is supposed to be optional. And para number 4B is supposed to be mandatory. It is supposed to be mandatory. So that is something which keep at the back of the mind. Now let's begin the input and ask you a question. So when you say that there is no chain, the example which we are considering is A has got a stake in B. So this is the example we're looking. A has got a stake in B. Now let me put across the questions to you. Can A avail para number 4A? Say yes or no. If A has got shares in B, there is no chain. Can he get the benefit
No.
of para number 4A? Yes or no?
No.
And that's great. Absolutely. So can I say para number 4A is not applicable? Para number 4A is not applicable for the company A Limited. Reason, there is no chain. Reason, there is no chain. I hope I stand very clear. So unless there is a chain, A cannot get the benefits of para number 4A. Now let's go further. In this case, can A get the benefits of para number 4B? Yes or no?
Yes, sir.
And is there any precondition where you can get a benefit of para 4B? He can get the benefits of 4B, but when? When? Can I say when he's an investment entity, right? Makes
Yes.
sense? Great. So I can say in this case, para number 4B, if you look at para number 4B, it all depends upon that I will put across a question. If A, is he an investment entity? If I say no, can I say A has to consolidate? I can say A has to consolidate. I hope I am clear on my thoughts. Then A in this case has to consolidate. But if you say A is an investment entity, can I say apply the three-step model? I would say apply the three-step model. Is my thoughts correct? So I think just to get a little more deeper into this part, let's give you some combinations which you can at random answer. A and B both investment entity. Will A required to consolidate?
No.
Very good. If A investment entity, B is not investment entity, but B does something similar to A, will A be required to consolidate?
Yes, sir.
Yes. And if A is investment, B is not investment, but B does not do something similar to A, is A required to consolidate B?
Yes, sir.
Not similar, I said. B does something which is not similar to A, no consolidation. The only case where I would ask A to consolidate is that A is investment, B is not investment, and B does something similar to A. If A be investment, no consolidation. A investment, B non-investment, not something similar to A, no consolidation. So the only case where consolidation would occur in this case is A is investment, B is not investment, but B is doing something similar to A. Correct. Is this left-hand side clear? That is the concept of chain. I hope I stand very clear on this. Any doubts you can ask me when there is no chain. Correct? Great. Now let's come to the case where there is a chain. So let's consider this is A, this is B, and this is C. So we're considering A, we're considering B, and we're considering C. Now watch this carefully. Now watch this carefully. There is a chain. Now, my quick questions to you, my very quick questions to you. Can A get the benefit of para 4A? Yes or no? Can A get the
No.
benefits of para 4A or not?
No.
No, because he's not the middle company in the chain. So we can say not applicable for A. Okay, so can B get the benefits of para number 4A? Can B get the benefits of para number 4A?
Yes, sir.
Yes. Can I say if there are four conditions? So we can say there are four conditions if all those conditions pass. Can I say in this case B is not required to consolidate? Correct?
Yes.
Yes.
Wonderful indeed. And if any condition fails, then B is required to consolidate, right?
Yes.
Yes.
Wonderful indeed. So this is on the para number 4A, that there is a chain. I'm looking at 4A. Now let's go to the para number 4B. Now watch this carefully. Can A get the benefits of para number 4B? Can A get the benefits of para number 4B?
Yes. Yes.
Yes. Can I say, is the status same as this one? Correct?
Yes.
So we can say it is same. So same in the sense, you'll understand it is exactly same, which means if A is not an investment entity, will he consolidate? If A is not an investment entity, will he consolidate?
Yes.
Yes. And if A is an investment entity, you apply your three-step model. Okay, now let's look at B. Can he get the benefits of para number 4B?
Yes.
Yes. Can I say same like this? Now B would stand, something on the top of the chain. So I can say the same as out here. If B is an investment entity, then you'll have to see in those particular case, can he get the benefits? Aha, the moral of the story now. The moral of the story, can I say in terms of a chain holding, B can avail para number 4A also, and B can avail para number 4B also. Am I right? If he's
Yes.
not an investment entity, he can get 4A. If he's both an investment entity, he can get the benefits of both the paras, right?
Right.
But what do you think which will prevail? If he's an investment entity, 4A tells him you got a choice, 4B tells him you can't. So can I say in both the cases, if there is exemption available in both, so what will prevail? Can I say para 4B will override 4A? Am I right? Will override the clause number 4A makes logical sense? Because A is giving you an option and para number 4B is telling you can't consolidate. I'll have to listen to para number 4B and I'll say you can't consolidate in that case. Okay, so this is a good summary which is done out here. Let me now consolidate the picture once again to you. You need to keep one thing very clear. The summary chart which I've given you is the crux of the entire scope of the standard. When you attack a question, you need to see that is there a chain or is there is no chain. The moment you see that there is no chain, you know one thing, that para number 4A is out of the picture. So your focus needs to be very clear. No chain means the para number 4A is out of the picture, and para number 4B can trigger only and only if A is an investment entity, and I'll evaluate based on the three-step model. So without a chain, the life is simple. 4A is out of the picture, and 4B is going to be applied in this particular case only if A is an investment entity. Now, if there is a chain, you need to understand that as far as A is concerned, if A is an investment entity, then he can get para number 4B. If he's not an investment entity, I'll tell him, boss, you have to consolidate. And as far as the middle company B is concerned, he can get the benefits of 4A also. He can get the benefits of 4B also, provided he is an investment entity. And if you decide something based on 4A, and if you decide something based on 4B, the decision under 4B will override the decisions under 4A. I guess before we proceed further, friends, let's get your comfort zones at this stage. If you would assess your comfort zones on a scale of 10 on the understanding of para number 4A, 4B, 31, 32, 33, what will you give yourself a score? Then I think we'll start doing case studies on this. 10 out of 10, that's wonderful indeed. Superb. Okay, that's great. 10 out of 10, that's wonderful indeed. So now I think we're in a position to do some questions on this area in the study material with you. So I guess I am just going to add the study material at this stage. Let me just add the study material. So this is the study material which I'm just uploading for the reference. Okay, so this is the unit number 3. Let's come to the illustration number 1. Let me just zoom this across to you. We'll apply the funda, very simple and straight. So let's, I think, consider the illustration number 1. So let me read the inputs in illustration 1 to you. There is a scenario number A. The following is the structure of a group which is headed by company X. Let's, I think, without reading the inputs, let's ask you something. If I say company X is not an investment entity, can you get the benefits of para number 4B? Quickly, yes or no?
No.
If X, yes, that's right. If X is not an investment entity, can I say the para number 4B cannot apply? Okay. Can he anyway get the benefits of 4A?
No.
That's right. Because in this case, if he's on the top of the pyramid, he cannot get the benefit of this as well. So can I outrightly say that company X on the top, I'll tell him, boss, you have to consolidate. You cannot get the benefits of 4A because you're sitting on the top. You're not an investment entity. You cannot get the benefits of 4B. You have to consolidate. Okay, now let's look at the inputs in terms of company A. If company A is not an investment entity, can you get the benefits of 4B?
Yes.
It's not an investment entity, I said. If it is not an investment entity, can he get the benefits of 4B? He cannot.
No.
Because unless you're an investment entity, you cannot get the benefits. But can he get the benefits of 4A? What do you say?
Yes.
Yes, he is in the middle company in the chain. If you fulfill the 4 conditions, you can. I hope my thoughts are very, very clear. Because when I'm looking on the top of the pyramid, I'm saying you're not an investment entity. So boss, no 4A, no 4B. And if in the middle of the chain, you're not an investment entity, I say no 4B. So you can get 4A. That is also if 4 conditions are met. So we're going to look at the 4 conditions now. It says company X is a listed company in India and prepares consolidated financial statements as per the requirements of Ind AS. Does it fulfill the 4th condition? Tell me. The ultimate parent is presenting a console for public use because it is listed and as per Ind AS. Is my 4th condition met? Remember
Yes.
the 4th condition?
Yes.
That
Yes.
the ultimate or the intermediate parent is presenting financials as per Ind AS 1 as for public use 2. So the 4th condition met. Then he says company A is an unlisted company. Can I say 3rd condition met? It's an unlisted company. Now that I would say the 2nd condition met. Because the 2nd condition is that it is not listed. And it is not in the process of listing. Can I say 3rd condition met? So we can see the 3 conditions met. Then he says company X. Now, company X has got 100% stake in A. Is the 1st condition also met? Wholly owned subsidiary of X, correct?
Yes.
So all the 4 conditions met. There is no NCI, so I don't need an NOC as such. Though it says company X does not object to company A not preparing the console. But I think in this particular case, to my inputs, if there was an NCI, I would need an NOC. But if there is no NCI, NOC in any case is not required. So all the 4 conditions are required, done. A is the wholly owned subsidiary of X. Condition 1 met. It's not listed. Condition 2 met. Not in the process of listing. Condition 3 met. And the ultimate parent is presenting console for public use 1 as per Ind AS 2. All the conditions met. So whether company A is required to prepare a consolidated financials as per 110. So tell me, is A getting a choice or am I mandating him?
Choice.
Yes. So I would say in this case, A gets a choice. He wants to make a consolidated financials. I will say, go ahead. He doesn't want to make a consolidated financials. I'll say, okay, it's your choice. Wonderful indeed. Let's go to the scenario number B. So I think the best way is always to look into 4A, 4B, get the analysis clear. You can never ever go wrong.
So for company A, if it is choice, then it follow India's 109, right?
If he gets a choice, uh, okay,
Like,
then you mean to say that
not
what is he
C.
going to do? No, no, no. Then you are
Com-
saying what he will do in a separate financials, correct?
no, so company A is a choice and not follow India's 110.
Yes. No, no, but not 109. Not 109.
Okay.
If A is going to control over C, he's exempted to not to consolidate. But this investment in C will be shown as per 27. In this 27 at cost or fair value choice, not 109.
Okay.
Yeah. Okay, then it says scenario number B, it says assume the same facts in A, except that company X is a foreign entity and is listed on, it says, stock exchange of a foreign country and prepares the financial statements applicable to that country. So, will any of the conditions get failed? If company X is a foreign company and presenting the financial statements as per the gaps of that company, any condition will fail in this case?
No.
It will fail, no? Fourth condition will fail. If you notice in this case now, is the ultimate parent presenting a consolidated financial statements as per India's? No. Because he's listed in a stock exchange in a foreign country, he's making the console as per the gap applicable to that country. So my fourth condition will fail. And if the fourth condition will fail, then he does not get the exemption. So in this particular case, will your answer differ? Yes. So can I say, will A be required to consolidate? A will be required to consolidate. In this case, A will be required to consolidate in this particular case. Okay, now let's come to the clause scenario number C in this case. Assume the same facts in A, except that 100% of the investment in A is held by Mr. X, an individual, instead of company X. So, is there any condition which is going to fail in this case? Now, this is something which may be tricky because I did not
Yes.
tell you. So, what do you think? Any condition failing in this case?
Yes. Yes.
Which condition?
Fourth condition.
Fourth
Fourth.
condition, the ultimate parent is okay. Okay. Let me, I think, first come back on the standard and show you something more. See what it says in clause 1. It is a wholly owned subsidiary or is a partly owned subsidiary of another entity. Entity. In this case, is the company X a wholly owned subsidiary by an individual or by an entity? He says you should be a wholly owned subsidiary or a partly owned subsidiary of another entity. So, is it important that on the top of the chain there should be an entity or there should be an individual?
Entity.
Correct. So now if I come back on that agenda, we can see as per the facts of this particular case. Now, instead of this company X, if there is Mr. X on the top of the chain, can I say the very first condition will fail? Is my thought correct? So I would say the condition 1 will fail.
Yes.
Yes, absolutely. So therefore, the answer would be again the same. Yes, A will have to consolidate in this case. Wow. Now, some key crucial points, which is coming from all the four conditions. The first condition is that on the top of the chain, there should be an entity. That's an important observation we have learned. So unless there is an entity, the condition 1 will fail because you need to be a wholly owned subsidiary of an entity, a partly owned subsidiary of an entity. So if on the top of the chain there is an individual instead of entity, the condition number 1 will fail in that case. The fourth condition, what we've learned, the focus point is that in this particular case, it should be presenting consolidated financial statements for public use. And the second important element is as per Ind AS. So if on the top of the pyramid is a foreign company and it is presenting financial statements as per the foreign gaps, then the fourth condition will fail. So at the end of the day, what is important is that when you look at the top company on the chain, it should be an Indian company presenting console as per Ind AS for public use. And secondly, it should be an entity and not an individual. Okay, so this is done. Now let's go further. Let's go to the illustration number 2. Some beautiful, interesting questions in the study mat on all the scope learning. Let's go to the illustration number 2. So let me read the facts now. There are some more interesting facts coming out in this particular case. The following is the structure of a group which is headed by company A. Now let me, before I read the inputs, let's, I think, make a walkthrough. If company A is not an investment entity, can you get the benefits of para number 4? Can you get the benefits of para number 4B? Tell me yes or no. If A is not an investment entity, can you get the benefits of para number 4B?
No, sir.
That's right. And can he in any way get the benefits of 4A?
No.
No, because you cannot get the benefits unless you're a middle company in 4A. He's not a middle company, he's not an investment entity, so that is gone. Okay, now as far as B is concerned, can I say he doesn't have a subsidiary? So I'm not looking at any analysis for B. But C is the middle company which is a subsidiary. Now, if it is not an investment entity, can you get the benefits of para 4B?
No.
No, that's right. So if you're not an investment entity, you're out. Can you get the benefits of para 4A if the 4 conditions are met?
Yes, sir.
Yes. So in all these cases, we have not inserted any investment entity so far. We will be inserting an investment entity also. Okay, let's go further. Now we're looking at things from the company C point of view. It says company A is a listed company in India and prepares a consolidated financial statements as per the requirements of Ind AS. Which condition is met? A is
Fourth.
preparing console as per Ind AS, listed company, public use.
4 condition.
That's right. The fourth condition is met in this case. Because when you're a listed company, you're presenting the financial statements for public use and then you're presenting as per Ind AS. So there are 2 inputs of the fourth condition. Public use means you're listed and therefore you're presenting for public. And the second part of the condition is that as per Ind AS. Next. It says company C is an unlisted company. So which condition met?
Sec.
That's right. And it is not in the process of listing, can I say third condition met? Now the only one condition left over. It says 60% of the equity share capital of C is held by A. We can see that clearly that 60% is held by A. And the balance 40% is held by other outside investors. Now, is C a wholly owned subsidiary of A or is a partly owned subsidiary? I think it's definitely a partly owned subsidiary. So what do I need now in this particular case? If he's a partly owned subsidiary, do we need a NOC from those remaining 40%?
Yes, sir.
Yes. It says company A does not object to the company not to prepare console, but I think I need to get that 40% NOC. So on the presumption that you get an NOC from that remaining 40%, then I would say C company will get the choice of not consolidating, the choice. So let's go further. So I'll just, I think, maybe take this out here. So in this particular case where the company C is required to present a consolidated financial statements as per 110. So we can say he gets a choice in this case. If all the four conditions are met, he gets a choice. Okay, now let's go further. It says scenario B. Same facts as per scenario A, except that 40% of the equity share capital of C is held by company B. Now, 40% held by company B. Now, if you say that this company has got a 40% stake in this company, now do you need an NOC? 60% is with A and 40% is with B. So do you need an NOC of company
No,
B now?
no,
That's right. Because company A and company B together have 100% shares in the company. So at the end of the day, since B is under the control of A, then you don't need an NOC from B because you can say A directly and indirectly. Mind the words, A directly and indirectly through B has got a 100% stake in C because there is no outsiders involved. So when you say that he's got directly, indirectly 100% stake in C, no consolidation is required, no NOC is required. So I can say in this particular case, whether C is required to inform the other owners B of its intention not to prepare a console, I would say no. He doesn't need to do that. Because we can say directly, company A directly, that is 60%, and company A indirectly, that is 40%. So company A directly, indirectly has 100% stake, in company X. So since he's got 100% stake in company X, we don't need to inform anybody. We don't need to tell them that I'm not making a consolidated financial statements in this particular case. Other factors met, so we can say he definitely gets a choice in this case as well. Wow. And that's not difficult. Though you can see in all these questions, none of the companies are investment entity, but I'm still making a walkthrough in terms of para number 4B, because I think you should, revisit these questions once you know the concept of para 4A and 4B. That gives you much better concept clarity as well. Let's go further. I guess I'm carrying some questions now with me, which I'm going to share on the concept of control assessment. So this is done, I guess. We can have a look at this particular question. Yes, wow. So let me, I think, share a small little question at this stage. This is a question which is there in the study material that's going to give you a good insight as well. Let me know, friends, if this is clearly visible to you. I think so.
yes,
Wonderful indeed. Now, this is an interesting question. It blends the concept of para number 4A and the concept of 4B, 31, 32, 33. Now, there is a chain as well. Now, I'm going to put some questions to you. First, we'll analyze the situations and then move forward. It says following is the structure of a group which is headed by PQR. I'm very clearly given that this is a non-investment entity. So can you get the benefits of para 4B? Yes or no?
no, sir.
Great. So he cannot get the benefits of 4B. Can he get the benefits of 4A?
No, sir.
No, because he's on the top of the chain. He cannot get any benefits on that case. Okay, now let's come to XYZ. He is an investment entity. Can he get the benefits of para 4B?
Yes,
Yes. So since he's an investment entity, I can apply my three-step model. Can he also get the benefits of 4A? Can he also get the benefits of 4A as well?
yes, sir.
Yes, he can. He can get the benefits of 4A as well. And in case he gets the benefits under both of them, what is going to prevail, 4B or 4A?
4B.
Correct. So in this case, if he is able to connect both the paras, the para number 4B is going to prevail over this. Wonderful indeed. Now let's go to the company below XYZ. Now A is a non-investment entity and B is also a non-investment entity. Now in terms of A, it says it is a subsidiary of XYZ carrying on the services that relates to the investment activities of XYZ. He does similar work which XYZ does, but nothing is given for B. In view of the above structure, whether PQR and XYZ are required from the respective reporting standpoints to present console. For the above purpose, assume that the other conditions in 4A1 to 4A3 related to such exceptions are met. Okay, now let's, I think, ask you the inputs. Let's first run the para number 4B for the middle company. It's an investment entity. So let's run the para number 4B. Now, are you going to run this para number 4B for A and B simultaneously or separately? There are two subsidiaries. So are you going to run the para number 4B separately or collectively?
Separately.
That's right. So I will run for A Limited separately. I'll run for B Limited separately. So what we're going to do, we will apply a three-step model in terms of A and B. Let's begin the journey for A. Let's begin the journey only for A. So first of all, in terms of step A, is company XYZ the parent company investment entity? So we said XYZ Limited, is it an investment entity? We said yes. So what should be my course of action?
Step number 2.
Wonderful indeed. Since it's an investment entity, we go to the next one. Now we said that is A Limited an investment entity? And we said no. So what do we do now?
Step number 3.
That's right. And now we say that is A got similar services like XYZ? And the answer is a yes. He is carrying on the services that relates to the activities of XYZ. So what is the conclusion? Is XYZ required to consolidate A or not?
Yes, sir.
Yes.
Consolidate.
So we can say XYZ is required. It is required to consolidate, you can say A Limited. Now let's make a walkthrough for B. So this condition remains the same and this condition also remains the same. But what about the services? Nothing is given. So can I say services are not similar? And if they're not similar, is XYZ required to consolidate B or no?
No, sir.
No. So we can say XYZ not required to consolidate B. Okay, so this gives me the analysis in terms of the three-step model evaluating the para number 4B in this particular case. Okay, now let's also consider the applications of para number 4A as far as this company X is concerned. All the conditions are met. Now, is XYZ wholly owned subsidiary of PQR? Yes, it is. So we can say that XYZ is 100% owned. It is 100% owned by PQR. And he is very clearly said below, for the purpose, assume that other conditions mentioned in the para 4A are met. So can I say all conditions met? If all conditions met, what is the conclusion? Is company XYZ required or gets a choice to consolidate?
Choice.
Correct. So in this particular case, we can say XYZ has a choice. XYZ has a choice to consolidate A and B. So he's got a choice to consolidate A and B. Now looking at the results in 4B and looking at the results in 4A, what is the conclusion? Para number 4B is saying you have to consolidate A, and para number 4A is saying your choice.
Para 4B is previous.
Yes, so we can say XYZ has to consolidate A, right?
Yes, sir.
And can I say, as far as B is concerned, B may or may not be consolidated. B may or may not be consolidated in this case. So I think that gives us a good analysis. This is one of the questions from the education material issued by ICAI on NDS 110, which gives us a clarity of thought with regard to what is done. Wow.
Some mandatory, na? XYZ
Yes.
is a mandatory, not required to consolidate B. May or
Okay.
may not
Yes.
be.
Yes.
Because
Yes. Yes.
4B, 4B is.
Yes. You're right. You're absolutely correct. So in this particular case, we can say that B cannot be consolidated. You're right. B cannot be consolidated. In this case, A will be and B cannot be consolidated. You're right. Absolutely. Well, so I think that gives us an insight on the scope of the standard. So in terms of my block number one, I'm done with the concept of the scope, understanding the concept of para number 4A, the four conditions, chain holding, optional in nature. 4B, which is supposed to be chain or no chain, doesn't make a difference, but mandatory in nature. Contradiction in 4A, 4B leads to 4B overrides the clause number 4A in this case. Wonderful. Okay, I think this is one phase done. I think it's time to give you some break now. So the scope of the standard is understood. Now, what I'm going to take you further is on the assessment of control. We are now going to go deep in terms of understanding how does a control assessment take place in terms of 110, because that is not something which is, ruled based. It is something which is principle based and requires some kind of analysis. Let's first give you a break, relax your minds. I'm going to see you in 10, 12 minutes, and we'll start with the control assessment. Break लगा दीजिए. Okay, thank you. relaxation of mind. So we're done with the first part of a block one, that is scope of the standard, deciding the parameters of para number 4A and 4B. Now I'm going to come to the subjective assessment part. That is, how do you assess that there is a control? So I think let's first of all take you to the insight of what Ind AS 110 talks about when you assess that there is a control or not. So I think let me just take it further. I'll just come back on the agenda. So I'm going to take you back on what the standard states on the control assessment. So first I'll give you a chain of thought. How are we going to think about the control assessment part? Let me just find out the page where it is. Yes. So let's first of all come back to the para number 5, which talks about the assessment of control. Now, first thing which I would like to clarify at this particular stage, control assessment under 110 is principle-based assessment. Unlike what you have done in AS21 in terms of IGAP, it was more like a rule-based assessment that you've got more than 50% voting power in a company. We say that yes, you get a control. But if you look at the parameters in terms of 110, there is no reference in terms of any kind of a percentage. The concept is purely based on some principal applications. Now, what are this? Let's read. I'm just going to read some inputs in para 5. Then I'm going to develop a simple step-by-step model. I'm going to give you a 3-step model on which we're going to work in terms of control assessment. Let's have a look. It says an investor, regardless of the nature of its involvement with an entity, shall determine whether it is a parent by assessing whether it controls the investee. Now, it says in the terms of para number 6, an investor controls an investee when it is exposed or has got rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Now you can see there is no reference to the percentages. He's only talking in terms of power. He's only talking of the ability to exercise that power to influence, you can say, variable returns. So things are organized in terms of para number 7. Whatever is given in para number 6, the parameters have been set in terms of para number 7. Thus, an investor controls an investee if and only if the investor has got all the following conditions. It says clause number A, power over the investee. The clause number B, exposure or rights to variable returns from its involvement with the investee. And the clause number C, the ability to use its power over the investee to affect the amount of investors' return. Wow. Well, let's first hear the chain carefully. We'll start working on this 3-step model, but I think first let's get the chain clear. In order to prove that as an investor, you've got a control over the investee, you need to put across a simple 3 steps to yourself. The step number 1 is, as an investor, do you have power over the investee? Now let's get not worried on what is power. We will see in detail what is power. But I'm just trying to put in the questions at the back of your mind. The kind of questions you need to put across, that should be clear. How do you assess power? That will be seen later. So the first question we're going to put across to ourselves is, does the investor have a power over the investee? The key word is power. So as an investor, you need to get a power over the investee. If you say a yes, I go to the step number two. In step number two, you need to see that is the investor exposed to variable returns from his involvement with the investee. Now, the second key word is exposure to variable returns. So I'm going to first of all put across a question as an investor, do you exercise a power over the investee? If you say yes, I'll say, as an investor, are you exposed to variability of returns due to your involvement with the investee? If you say a yes, I go to the step number three and I'll say, can you give me the relationship? Can you develop a relationship between power and the exposure to variable returns? That because of this power, you are exposed to variable return. You will be taking certain decisions, and those decisions would influence the return to the investor. It says the ability to use the power to affect the amount of investor's return. The power which you have got, once you exercise the power, it will influence the returns of the investor, which is technically called linkage between power and return. So the three key words which you need to put across is control is dependent upon three factors. Do you exercise power? That's the key word, power. Number two, are you exposed to variable returns? That is two. Can you give me a linkage between power in step one and the exposure to variable returns in step two? If you say yes, you've got a control. Now, we're here to understand what is power. We're here to understand what is exposure to variable returns. We're here to understand the linkage. But at least the thought process is done. So let's do one thing. Let's first map down the parameters of control. So we are on the second part of a block one, and that is called control assessment. And that is called control assessment. So just to put it down again, when I say control assessment, what you need to keep in mind is it is not rule-based. The control assessment is not rule-based assessment, but you can say it is something which is principle-based assessment. It is a principle-based assessment. We'll have to look at the facts of the case and then decide that as an investor, do you control the investee or not? So let's pen down the three-step model. Then we'll start working on this. So in terms of the three-step model, step one, step two, and step number three. So I'm going to first of all put across a question that there should be a power. That's the key word. So I'm going to put across the question, does the investor exercise power? Does the investor exercise power over the investee? So does the investor exercise power over the investee? It is only when you say a yes that I go to the step number two. So you need to first of all put across a question that do you exercise power over the investee? The second question we're going to ask ourselves is, the key word is variable return. The second key word is variable return, and that is the investor exposed to? Is the investor exposed to variable returns? Is he exposed to variable returns from his involvement? From his involvement. So is he exposed to variable returns from his involvement with the investee? So because of his involvement with the investee, is he exposed to variability of returns or not? So the key word is power, the key word is variable return. And then the third element is we need to look into the linkage. We need to establish the linkage between power and return. We need to prove the linkage between the power and the return. So let me put it like this. The step number 3 is not at all requiring much assessment. So if you say in step number 1, yes, you've got power. And if you say in step number 2, yes, you're exposed to variability of returns, then I would say the third step is implied. The linkage is already there. And if the linkage is there, I would say, yes, you've got a control. So I don't need to really work on my step number 3. Once I establish that, yes, you've got a power, once I establish you're exposed to variable returns, step 1 is a yes, step 2 is a yes, the step 3 automatically the linkage is developed. I don't need to do any further assessment. And then I will immediately conclude that yes, there is a control. So basically, I need to work upon the step number 1 and I need to work upon the step number 2. I don't need to work upon the step number 3. So what we're going to do now, we're going to work upon the step number 1. We're going to first work upon only the element of power. Now, when you say that you've got a power, you cannot conclude that you've got a control. Power is just one element of control. The other one is exposure to variable return. So we're just concentrating on step 1, that is power. I hope, friends, my thought processes are very clear in terms of understanding the first element of control is power. Let's go ahead. Now, I'm going to give you something more in terms of power. So let me just take you in terms of what the para number 10 and the para number 11 tells you. I'm just reading the inputs in terms of para number 10 and in terms of para number 11. So we're now concentrating in terms of step 1, power, only power. Now let's see the power. It says investor has got a power over the investee when the investor has got existing rights. That is number 1. That gives it the current ability. That is number 2. To direct the relevant activities, and that is number 3. So when you say that you've got power, I would say power has got 3 sub questions to be put across. Do you have existing rights? Now, what are existing rights? Don't get worried on that. Do you get the current ability? What is current ability? Don't think at this stage, just the words. So when you say that you've got a power over the investee, put across a question. Do you have existing rights? 1. It gives you a current ability. 2. And to direct relevant activities. 3. The what is relevant activities are defined activities that significantly affect the investee's return. So I would say the power is supposed to be a sum total of 3 elements. One is called existing rights, one is called the current ability, and one is to direct the relevant activities. If all these 3 parameters are met, I would say you've got power. Wow. So now as we're moving layer by layer, we are now thinking in terms of power where you need to put across 3 sub steps as well. So when you say that as an investor, you've got power over the investee, I would say number 1. I would say number 1, do you have existing rights? We're just working upon the questions to be put across. Do you have existing rights? That's 1. Does it give you a current ability? That's 2. And number 3, that is to direct relevant activities. Now, what are relevant activities? Any kind of activities that could change, you can say, the profitability of the investee. Activities that could significantly affect the investee's return. So if I have got certain kind of rights, which puts me into the ability where I can decide the fate of certain activities which could change the profitability of the investee company, I could be said to have a power. Okay, now it says power arises from rights. He's talking about those rights. So he's telling you that power generally stems out of rights. Then he says sometimes assessing power is straightforward, such as when the power over the investee is obtained directly and solely from the voting rights granted by equity instruments such as shares, and can be assessed by considering the voting right from other shareholders. But in other cases, the assessment will be more complex and requires more than one factor to be considered. For example, power results from one or more contractual arrangements. Now let's pen the thoughts down. So when you say power is an element of three factors, existing rights. Rights would be on account of either voting rights, or there could be other parameters as well. There could be other parameters as well. For the time being, let me, I think, give something at the back of the mind. When you say that you've got a power, you need existing rights. I would say existing rights would be basically voting rights, or maybe the right to appoint or remove the key management personnel of the company. For the time being, we're just going to consider that. So, which means if you say that as an investor, you have power, the first question I will put across is, do you have any existing rights? Are you an equity shareholder of the investee company? Or do you have the right to appoint or remove the key management personnel of the investee company? That would mean that there's some kind of rights that are with you. But when you say that you've got those rights, we need to see that are those rights going to give you a current ability? Now we need to understand what is this current ability. But we can say the current ability means that you should be in a position to use these rights to do what? So that you can direct the relevant activities of the business. So if I've got, let's say, a voting right, and I am in a position that is a current ability to decide the relevant activities of the investee, due to which the profitability of the investee company is going to get influenced, then I can say I've got power. And at the same time, if I am exposed to variability of returns, then I would say the second parameter gets met, and then connecting the first and the second, I get a control. Now, everything seems to be, quite loose-ended at this stage. No worry. What we're going to do, we're going to work upon the entire chain of thought. So let me do one thing. Let me just come back on the agenda, and let's now concentrate on power. Then let's connect the dots. So we are first working on the concept of power. That is element number one, step number one of my three-step model. So when I'm looking at power, just to connect the dots, just go back and see. We're working on the step number one. We're working on the step number one. And this is, you can say, the step one of three-step model. It is the step one of the three-step model. So we're just working on the step number one itself. So power is got three elements. So we can say power is got three elements. This becomes step number 1A, step number 1B, and step number 1C. As we go to proceed further, understanding the concepts and do practical illustrations on control assessment, we look at step 1 ABC, step 2, step 3, and then decide the control. So step number A is supposed to be existing rights. So for power, what is important is that you should have existing rights. Now we can say, when you say existing rights, generally, so we can say generally, when you look at existing right, generally, it comes from voting rights. Generally, it comes from voting rights. So existing right should be in the form of voting rights arising on account of equity shares in investee. Arising on account of equity shares in the investee. So we are saying generally, when you say that you've got existing rights, these existing rights should be in the nature of voting rights. And we can also say, just to add on the point, so we can say this can also arise from the right to appoint. It can also arise from the right to appoint or remove. It can also arise from the right to appoint or remove the key management personnel, KMP, of the investee. If I am in a position to appoint or remove the key management personnel, that is also considered to be a right. an existing right. But generally, when you consider existing rights, what should be the back of the mind is voting rights. Next, the second element in terms of power is supposed to be current ability. It is supposed to be the current ability. So the question rises, what is a current ability? Now, let me clarify one thing right away. When you say current ability, what comes at the back of the mind is the ability which is there as of now. No. When I look at the concept of current ability, the concept of current ability means when the need arises. My existing rights will be putting me in a position when the need arises that I can direct relevant activities at that time. So do not interpret the word current ability on a literal sense. You cannot say that current ability means as of now. Current ability would mean when the need arises. Current ability means when the need arises. So when the situation will occur, when decisions are to be taken at that stage, will you be in a position to take decisions at that stage or not? So it's not as of now, it's not as of present, but it is when the need arises. And the third element is to direct. To direct what we call relevant activities. So what we call relevant activities. So the standard has also given us a list of what are relevant activities, but per se, when you're looking at relevant activities, we can say those activities which can significantly impact, returns of investee. So all those activities which could significantly impact the returns of the investee. Let me just now connect the dots. Because I need to work upon this. Right now, I've just given you a chain of thought. We need to start working on this chain of thought, understanding each and every crucial bit of the control assessment. It is undoubtedly a subjective assessment altogether. Now, let me just connect the dots once again. So I'm now going to give you a thought process. So think with me on this chain. I'm just going to give you a thought process and we're going to work upon this particular chain. So if somebody tells me that what is the control assessment under Indes 110, I'll say, okay, if you're looking at a control assessment, I'll say, let's give you a thought process in terms of control assessment. I'll say in terms of control assessment, step number 1A, step number 1B, and step number 1C. I'll say you want to make an assessment of control. Let's get the chain very clear. I'll say, okay, tell me, do you have power over the investee? So the chain number 1 is, I'll say, okay, do you have a power over the investee? Now, somebody would say, what do you mean by power? What do you mean by the concept that you've got a power over the investee? I'll say power over the investee is, prove it to me that you've got some existing rights. So somebody will say, what do you mean by existing rights? I'll say generally voting rights. So I would say it is generally voting rights. So I will say as an investor, do you have voting rights in the investee? You say, yes, I've got voting rights. I'll say, great. That is the first element which I'm looking at, that you've got voting rights in the investee, great. Then I'll say, okay, will your existing rights give you a current ability? The word current ability connotes it seems as of now, but it's not as of now. We will work upon this in detail. Current ability, that means when need arises. When the need arises. So what we're going to do, we will work in detail on existing rights. We'll work in detail. We'll dig deep into what are existing rights. We'll dig deep into current ability. But as of now, I'm just giving you a framework. Existing right means voting rights. And then it gives you the need current ability, when the need arises, these existing rights will be putting you into a position where you can take decisions. So I'll say, when the need arises to do what? The need arises to direct the relevant activities of the business, to direct the relevant activities of the business. The standard has also given us a list of relevant activities as well. The standard has given us a list of relevant activities as well. So what we'll do, we'll go the opposite way. To understand the concept of power, I'll first give you a list of relevant activities. Then I'll come to the aspect of understanding current ability. Then I'll come to the existing rights. So we're going to go reverse gear. That we'll say control depends upon power. Power depends upon existing rights, current ability, as well as to the relevant activities. So we'll first understand what are relevant activities, which activities influence the return of the investee. Then I'll say, let me understand what do you mean by current ability, and then I'll say, let's get into existing rights. So we'll go like this: relevant activities, current ability, and existing rights. So once you've understood that, you know that as an investor, you got power. Step 1, ABC. Then you go to the step number 2. And you will say that you should be exposed. You should be exposed to variable returns. So your involvement as an investor with the investee should be exposing you to variability of returns. So let's call the second parameter as return. It's variable return, but that's the second parameter, return. So once we've understood relevant activity, current ability, existing rights, we'll come to the step number 2, understanding the exposure to variability of returns. And then comes the step number 3, wherein you need to develop a linkage. You need to develop a linkage between power and return. So where you need to develop a linkage between the concept of power as well as the concept of return. Wherein I don't need to do anything, because if you say you've got a power, you're exposed to variable return, linkage is automatically done. I hope, friends, my thought process is now clear. I know you must be still worried about existing rights, current ability, relevant activities, exposure to variable returns. What are these? But the idea right now is to just create some thought process at the back of the mind. How are you going to think? What kind of questions you're going to put across to make an assessment that as an investor, I control the investee. Am I clear on my thought process at this stage?
Yes, sir. 100.
Wonderful indeed. Superb. Okay, now we're going to first of all work on the step number 1C. I'm going to first work upon the step number 1C. So I guess I need to take you back on the standard. In between, I've inserted the study material. I will just take you to the list of relevant activities which are given at the appendix of the standard. Then we'll start working on the relevant activities with you. Yes, so here we've got interesting examples on the relevant activities. So let's take you to the para number B11 and B12 in the appendix to the standard. In the appendix to the standard, I hope that is visible, right? Okay, I think maybe I can just, crop this further because I don't need this. Yes, I think this will be visible enough. So we're looking at the para number B11 and B12. So let me tell you, we are working on the step number. We are working on the step number 1C. That is on the concept of relevant activities. It says for many investees, a range of operating and financing activities significantly affect the returns. Examples of activities that, depending upon the circumstances, can be relevant activities include, but they're not limited to. The para number B11 gives you a list of activities which are relevant. Your existing rights should put you in a position that you can take decisions on these activity. I put it again. So when I say existing rights, your voting power should put you into a position so that you can direct these kind of activities. So we're looking at examples of activities which you as an investor can decide. It says selling and purchasing of goods or services, managing the financial assets, selecting, acquiring, or disposing of the assets, researching and developing new product or processes, determining a funding structure, or obtaining the funds. This is not an exhaustive list because it says it's not limited to, but this is illustrative in nature. If you can decide which goods to sell and which goods to buy, if you can decide which assets to acquire and sell, if you can decide how do you manage the financial assets, what's going to be the business model of the company. So if you can decide the funding structure, the debt equity financing in the company. So if you can decide the debt equity structure, if you can decide the R&D activities, if you can decide acquisition and disposal of assets, managing the financial assets, selling the goods and services and purchase of goods and services. These are few examples of activities which could indicate that as an investor, if you are in a position to decide and take decisions on these activities, then we can say, yes, you're getting power. But you should be in a position to take decisions on them. Because when you say current ability means that when the need arises to take decisions on the list of activities, you should be in a position to say, boss, I will take decisions on these activities. So as an investor, if I can take all these decisions of the investee company, I would significantly impact the returns of the investee company. The profitability of the investee company is in my hands. So I would be said that I've got a control. So I'll just pen down the list of these relevant activities. So let's go back. So I'm just going to put the notes at the right place so that the chain is connected well. So on the step number 1C, let's, I think, give you the connect. So let me just add something out here. So we're going to add the inputs. That is on the step number 1C. So we're looking at the inputs in terms of 1C. Then we'll go to 1B, going reverse gear. So this is, you can say, relevant activities. We're looking at relevant activities. So first of all, we can put it in generic that when you say relevant activities, we can say those activities which will significantly impact, those activities which can significantly impact returns of the investee. It will significantly impact the returns of the investee. So all those activities which can significantly impact the returns of the investee, and we can say, let's give you some examples. And these examples are illustrative in nature. These examples are illustrative in nature and not exhaustive. These are purely illustrative in nature and they're not exhaustive in nature. So I'm giving you examples which are given in the standard itself for your reference later. If you want to refer, this is the inputs which are given in para number B11, that is Appendix B. It is given in the Appendix B of Index 110. So in the Appendix B, in para number B11, which is called the AG, Application Guidance. In the application guidance, we are given all these examples. So let's pen down a few examples. Number 1, sale or purchase. Sale or purchase of goods and services. I'm putting it as GS. You'll understand goods or services. Number 2, It is managing financial assets. I'm putting it as FA. Number three, we can say taking decisions on debt and equity financing. Basically, funding decisions, taking the decisions on debt equity financing. That's number three. Number four, acquiring or disposal. It's deciding the acquiring or disposal of assets. So acquiring or disposal of the assets. So you're taking all these decisions in this case, and you can say R&D. I'm putting it as R&D, research and development, etc. So this is the list of activities. If as an investor, you can take decisions on these activities of the investee, you are in a position to significantly impact the returns of the investee. Right, friends? So step number 1C is done. That was just to give you a flavor in terms of the relevant activities of a business. Now we're going to work upon the step number 1B, current ability. Current ability. So let's go to the next step. That is step number 1B. So in terms of step number 1B, we're now looking at current ability. I have already said current ability does not mean as of now. So when I say current ability, it does not mean as of now. It is when need arises. It is when the need arises. It is not as of now. It is not as of now. So it doesn't mean that you're in a position to take the decisions today. You should be in a position to take decisions on these activity when the need arises, futuristic. So when I say when the need arises, I am basically looking at future. That when the need will arise at a future date, will you be in a position to take decisions on all these relevant activities or not? Now I need to blend financial management along with financial reporting. Oh my God, you must be thinking, so what happened suddenly? What are you saying? That you're going to blend the concept of financial reporting with a bit of financial management, or I would say rather SFM, blending the concept of derivatives as well. I guess, friends, you remember the concept of derivatives, that is forward contract, as well as the concept of options contract, call options and put options, what we did in terms of financial instruments, right? Can I safely assume that to be yes? That's it.
Yes.
Great. So I'm now going to give you some situations before I come to the practical example, and you need to decide something. So please hear this carefully. I'm now going to give you some permutations and combinations. I'm going to give you some permutations and combinations. These are the permutations, combinations of existing rights. These are permutations, combinations of existing rights. I'm still not on step number 1A, but to explain 1B, I'm giving you examples of existing rights. Number one, as an investor, you already have majority shares in investee. I can say this is definitely an existing right. As an investor, you've got majority shares in the investee. Majority means that you are almost with a more than 50% voting power in a company. That's an existing right. Next, when I say existing rights, another one could be that you are a party to a forward contract. You are a party to a forward contract to acquire majority shares. To acquire majority shares. Do you call this as an existing rights? Yes. I may not have majority shares today. That's fine. But I am a party to a forward contract where I will acquire majority shares. That's an existing right. Now imagine a situation, please hear this carefully. There is a meeting of the shareholders which is yet to take place in 2 months' time. Please hear me carefully. There is a meeting which is scheduled to take place between the shareholders in another 2 months' time. But before this 2 months, my forward contract will expire. Can I say once the meeting takes place, I will be getting the majority voting shares? Do you think I might get the ability when the meeting takes place? Yes or no? And that's right. Undoubtedly, yes, in this particular case, because when you enter into a forward contract, you will definitely exercise the rights. So I know that the meeting is scheduled to take place in the next 2 months, and sitting today, I say that once the meeting takes place, I will be able to exercise the forward contract. Today, somebody else may be a majority shareholder, but once the meeting takes place, I will be the majority shareholder. So, does it put me into a current ability? Does it put me into a situation that when the need arises, I will be, taking decisions at that stage? Today, I may not have voting rights, but once the meeting takes place, before the meeting, the forward contract is settled. I will be in a position to take decisions at that time, futuristic. The another one could be that you are a party. You are a party to an option contract. You are a party to an option contract. And this is again to acquire majority shares. This is again to acquire, let's say, majority shares of the investee company. So what we are trying to say is that you already hold majority shares. That is an existing right. You are a party to a forward contract. That is also an existing right. You are a party to the option contract. That is also existing right. The point which I want to make at this stage is that you may not be having majority shares at the moment. That doesn't make a difference. Because I need to see that, once a meeting takes place, in that meeting, will you be able to, exercise these rights or not? So let's say if you entered into a forward contract before the meeting, the forward contract is settled, you will become a majority holder. But let me tell you, and let me rather ask you something. Can I say if it is a forward contract, can I say you will definitely exercise? You can't say that I'm not exercising. Is that thought correct?
No,
No, but if
definitely.
you enter into the forward contract, it is a contract which has to be honored irrespective. So
Binding
can I
contract.
say, so you can't exit out of the contract. So can I say if you're a party to the forward contract, you will definitely exercise? Is that right to say?
Yes, sir.
So in this particular case, since you entered in the forward contract, you will definitely become a majority shareholder of the company. But what is important, that do you need to become a majority shareholder before the meeting or after the meeting?
Up.
Think. After the meeting means that once the meeting takes place, then in that particular case, once the meeting takes place, you don't have majority shares, then nobody is going to listen to you. So in this particular case, we know that with this contract, you will definitely be in a position to take decisions. But should this contract get exercised before the meeting or after the meeting?
Before.
Yes. So it should get definitely exercised, but you will definitely exercise, but it should be before the meeting. It should be before the meeting. The day when the meeting will occur, your forward contract should get settled before the date of meeting. Otherwise, you will not get the power. Next, in case of an option contract, do you think you will definitely exercise or you may or may not exercise?
May or may not.
That's right. In terms of an option contract, it may or may not be exercised. It may or may not be exercised in this particular case because you may choose not to exercise. Now, that makes it interesting. In forward contract, you are legally bound to settle the contract, so you will definitely get majority shares. But you need to get the majority share before the data meeting. But in terms of an option contract, you may or may not exercise the option, so you may get you may get a majority shares or you may not get a majority shares. Now, let me ask you something. When you say that you may or may not exercise, when you say that you may or may not exercise, remember the kind of positions which were there. It was in money, it was at money, it was out of money, it was deeply in money, and it was deeply out of money. Remember all these positions which I gave you at the time of derivative discussions, correct? So now my question is, if you've entered into an option contract and you say it is in money, or you say it is at money, or you say out of money, will you definitely exercise or definitely not exercise or subjective?
Subjective.
Correct. Because when you say it's in money, you're not 100% sure you will exercise. And when you say out of money, you're not 100% sure that you will not exercise. And when it is at money, you're not 100% sure that you have an indifference point. So can I say in all these situations, in, at, out, it is going to be subjective whether you will exercise it or not. But if it is deeply in, will you definitely exercise?
Yes, sir.
Yes. So if it is deeply in, you will definitely exercise. So can I say only then you will get a majority stake in the company? So we can say that if your options are deeply in money, then there are bright chances that you will exercise the option. And by the way, should this exercise happen before the meeting or after the meeting? Because you've got majority shares and you're
Before.
saying, I will exercise. So can I say that should again be exercised before the meeting occurs? So that you're in a position to take decisions. And if you say it is deeply out of money, can I definitely say that I will not exercise? Then in that particular case, you're not going to get power. Let me just connect the dots. And we'll work upon the case studies and make some more interesting chart on that. So we're working on the step number 1B, where we're looking at the input in terms of current ability. We are saying current ability means not as of today. Current ability means when a meeting will occur where the decisions on relevant activities are to be taken. So when the meeting will occur at a future date, I should be in a position to prove that I will be in a position to take decisions at that time. Because as a investor, I have majority shares today, that's fine. I may not have majority shares today, but I'm a party to a forward contract or I'm a party to an option contract. But before the meeting, I will exercise these contracts and I will be in a position to get more than majority shares. Now, there is a little distinction between that when you enter into a forward contract, you will definitely exercise, you'll have to exercise the forward contract. It's not a matter of choice in those cases. When you enter into a forward contract, you need to honor the contract. So which means if you've entered into a forward contract and it is settled before the date, you will get majority shares at that stage before the meeting. So you will be able to exert power in the meeting and say that I will take a decision. But once it is a case of an option contract, it is something which you may or may not exercise. There is no binding on the part of the party that he needs to exercise the contract. So you may exercise, you may not exercise the contract. So whether you will exercise or not can be segregated in terms of the fact if the option is in, at, out money, it is subjective. You cannot say that I will definitely exercise. And if you say that it is deeply in, you will definitely exercise. And if it is deeply out, you will definitely not exercise. So you can say you will get a majority shares only if your option is supposed to be deeply in money, then you will definitely exercise. But that should also occur before the meeting. So the option contract should be something which is deeply in money and is exercised and is settled before the date of the meeting, then automatically you will get majority. Which means here you already have a majority, and in these cases, you will get a majority before the date of meeting. So once the meeting occurs and the decisions are taken on all the relevant activities, as an investor, since you are the majority stakeholder, you will take a decisions in all those relevant activities. Did you get the point? Clear with the funda? Let me now take you to some case studies on this area. We've got some very interesting case study in the standard as well. I'm just going to take you there. So there is an example which deals with the step number 1B, that is current ability, where we've got all these combinations. Then we'll summarize this input in a small little chart with you. Okay, here we have example number 3, which is given in the appendix to the standard. So there are some common facts which are given for the example number 3. These facts are common in terms of all the 4 combinations which we're going to look at. So let me just crop this up as well. So there are 4 examples, 3 A, B, C, D. And there are some common facts which are given. I hope that is visible, I guess, right? So let me look at the common inputs which are given in the example number 3. It says investee has an annual shareholder meeting at which decisions to direct relevant activities are made. Now, my quick question at this stage, the company has an AGM, annual shareholders meeting. So in the annual shareholders meeting, the decisions to direct relevant activities are taken. So my assessment of power is to see what, do you get a power today or will you get a power when the meeting happens? What do you say? So when I'm looking at the power, should I see that I've got a power today, or should I see when the meeting occurs, will you be having a power? Will you be able to take decisions on relevant activities or not? What do you say? Current or futuristic? That's absolutely correct. It says the next scheduled meeting is in 8 months from now. However, the shareholders individually or collectively with at least 5% of the voting power can call a special meeting to change the existing policies over relevant activities, but a requirement to give a notice to the other shareholders mean that such a meeting cannot be held at least 30 days. Which means instead of having this meeting 8 months later, you can also have this meeting in the next 30 days itself. If you give a special notice to everybody, then you can conduct this meeting where decisions on relevant activities will be taken in the next 30 days. So my assessment is now to see that will you be in a position to direct relevant activities in the next 30 days or not. Policies of relevant activities can be changed only at the special or scheduled shareholders meeting. This includes approval of material sale of assets, making decisions on significant investments. So all these are relevant activities in nature. So this is the common facts which are given for all the 4 examples which are yet to follow. Now let's consider the example number 3A, B, C, D. Investor has got a majority of the voting rights in the investee. Can I outrightly say that since you have got majority voting rights and if there is nothing to the contrary, when the meeting occurs in the next 30 days, you will be in a position to exercise the power to direct the relevant activities. Is the thought correct? The fact that it takes 30 days before the investor can exercise voting right does not stop the investor from having the current ability to direct the relevant activities. I think in this case that there is nothing to the contrary. Since you are a majority stakeholder of the company, I think in this case, once the meeting occurs, even today you've got power, even 30 days later you get a power, you will be in a position to direct all the relevant activities because you're a majority shareholder of the company. Next, it says investor is a party to the forward contract to acquire majority shares. Now that's an existing right. The contract is going to be settled in the next 25 days. Do you get a power? Yes or no? You're a party to a forward contract to acquire majority shares, and the settlement will be 25 days. Meeting is in the next 30 days. That's right. So we can say even in this case, we get a power. And I think even in this case, we get a power because the settlement is within the next 25 days before the meeting. So it says meeting cannot be held at least 30 days. Therefore, since the settlement will be done much in advance, you get power. Next. Investor is got an option to acquire majority shares in the investee. It is exercisable in 25 days and is deeply in money. Can I say the only combination in terms of an option contract where you will say that there is a power is when it is deeply in money and it's deeply in money and it is going to be exercised before the meeting. Is that correct? So the only combination where under an option contract you will be in a position to say that you get a power is number one, it is deeply in money, and number two, you are going to settle the contract before 25 days. I'll come to some permutation combinations very shortly. That's right. So I think the power comes here as well. And finally, it says in 3D, you're a party to a forward contract to acquire majority shares, but it says the contract is going to be settled in 6 months. The meeting is there in the next 30 days, and you're going to settle the contract in the next 6 months. Do you get a power? Of course not. Of course not, because by the time the meeting occurs, you will not get majority shares, so nobody is going to listen to you in the meeting. Let's do one thing now. Let's create some permutations and combinations at this stage. Let me just summarize the inputs in this case. I'll give you some inputs and you can give me the inputs on the summary chart. So I am giving you some permutations combinations. So one column for the particulars, one for some additional inputs, and then we will see that whether we get a power or not. So I am giving you some existing rights. I'm giving you some existing rights. And I'm giving you some further inputs. So let's see the analysis rather. And we'll decide the concept of power. So I'm going to give you some permutation combinations. Think of this. We need to basically look at the concept of current ability. So this summary chart is working on the concept of current ability. So let's give you the permutations combination. Number one, as an investor, you already have majority voting rights. So what do you say? Any analysis required, or we can say, yes, I've got power.
Yes.
That's right. No analysis required. Power is there because this will always give you a current ability. Next, you are a party to forward contract. You're a party to a forward contract, of course, to acquire majority shares. To acquire majority shares. Can I say the only thing which I'm going to see is the settlement date? The only thing which I'm going to see is the settlement date. So is the settlement before the meeting or after the meeting?
Before.
So if the settlement is before the meeting, then do we get power?
Yes, sir.
Yes. And if it is after the meeting, of course, no power. So forward contract only requires the assessment of the fact when are you going to settle. Next, let's look at the third one. So we are a party to option contract where I can say it's more like, long call. Because when you say that you're a party to the option contract, it basically means that you've got a long position. So it's a long call that you're going to acquire majority shares. So this is to acquire majority shares in this case. Okay, so now let's, I think, put the inputs back again to you. So when you're a party to the option contract to acquire majority shares, can I say first I will see is it in, at, out? Or I will say it is deeply in, or I will say it is deeply out. So if it is in, at, out, can I say subjective?
Yes, sir.
That's right. So in this case, I cannot say a yes or no. I would say it is subjective. Okay, if it is deeply out, can I say yes, no, or subjective? Deeply out.
No.
That's right. We do not get a power. And if it is deeply in, can I say I again have to see the settlement dates? Correct?
Yes, sir.
That's wonderful indeed. Because if it is deeply in, you'll again see the settlement is before the meeting or not. So, moral of the story, in all these examples, you can see that the assessment is futuristic in nature. We are not looking at that whether you can influence the decisions today. We are looking at the fact that with all these kinds of voting rights, when the need arises, when the meeting will occur and decisions on relevant activities are to be taken, whether you will be in a position at that stage to direct the relevant activities. So if you've got majority shares, unless mentioned otherwise, yes. If it is forward contract, it should get settled before the meeting. And if it is an option contract, it should be deeply in money and get settled before the meeting. Then you will be in a position at that stage to direct the relevant activities of the business. So out of my step number one, 1C, relevant activities done, 1B, current ability done. Now we're left with step number 1A, which is the concept of, you can say, existing rights, which we're going to make more work through in the next session with you. We're going to get more deeper into that. Then we need to go to the step number 2. 3 is simple because 1 is a yes, 2 is a yes. Automatically, the linkage gets developed as well. So no worries as we move to the next one. As I always keep saying that what you need to do, friends, you need to do a cumulative revisions of all these concepts. Though I think once the control assessment gets done, the practical illustrations will not require any control assessments, because when you get practical illustrations, we always assume that the control is there if there is more than a 50% stake. So for practical illustrations, you will never see situations where the percentages are below 50% and we're doing a practical consolidation. So in all the practical illustrations, the control assessments will not require. But invariably, if you see this concept, yes, there are not many questions which have come in the past, but they can definitely test you in terms of MCQs, when you look at the larger parameters of the control assessment. Right, friends. So I think that brings me to an end. So do we need to revise 103 as well? I think I need your inputs on 103 revision, typically on the NCI part and typically on the goodwill part. Rest, I think, is still manageable because whatever we have covered with reference to the goodwill impairment under 103, that would be handy. And whatever we've done in terms of NCI, that would be handy. Next session, we'll be covering, first of all, the aspect of control assessments. After that, I'll start with the practical inputs. How do you make a consolidation? We'll first work on the consolidated balance sheet, and then we'll move on to the consolidated income statement with you. Right, friends. So I think that seems to be all for the day. So see you in the next session. So please do make your revisions unless there are any further questions coming in.
Next is on which date?
Tuesday. Tuesday we have the class.
Thank you.
Thank you very much.
Thank you,
Are
sir.
there any questions you said on a standalone basis on a control assessment? Not in the examination, what I remember, but yes, in RTP, there are 1 or 2 questions pertaining to that. So we'll definitely, learn that, because even if it comes in the exam, you should not be a problem. The only thing is that control assessment becomes a little subjective assessment. So therefore, you don't find, case studies, longer kind of things. But basic parameters can always be tested as a part of MCQs and all. So in any case, you need to be aware of the control assessment part, I would say. Right. Thank you very much, friends. So we're going to see you in the next session. Thank you. Bye-bye and take care. Thank you very much.
Thank you, sir.
Thank you very much. Anji, thank you. Thank you. Thank you.